Getting pre-approved is not the finish line. It's the starting line. And the 7 things most people do between pre-approval and closing are the exact reasons their loan gets denied just 3 days before they get the keys. My name is Justin. I'm not your typical CPA. I focus on business growth and finance. Let's go. So here's the big idea. You got pre-approved. Congratulations. You found the house. You made the offer. It was accepted. You called your mom. You started measuring furniture. And then 3 days before closing, your lender called you and said, "We can't fund this loan." Do you know what happened? You did one of the 7 things I'm about to tell you never to do between pre-approval and closing. And that one thing, the furniture store credit card, the new car payment, the job change you thought was an upgrade, that one thing just cost you the house. Over 7,500 VA loans were denied after pre-approval, not before, after. These people were told they were approved, and then they weren't because they didn't know the rules of the danger zone. The zone between pre-approval and closing, where one wrong move kills everything. I'm giving you every single rule right now so you close on time. Check it out. So picture this. You just got pre-approved for a mortgage. You're excited. You walk into that furniture store because you need a couch for your new place. The salesperson says, if you open a store card today, you get 20% off. 20%? That's $400 off a $2,000 couch. You think I'm about to be a homeowner? I deserve a nice couch, and I'm saving $400. So you end up applying and you get the card, you buy the couch, you drive home feeling like an adult. Here's what you didn't know. That scorecard triggered a hard inquiry. Your score dropped 10 points. The new $2,000 balance spiked your utilization. Your debt to income ratio went up. And when your lender repulls your credit 48 hours before closing, which they always do, they see a different file than the one that they pre-approved. The offer gets pulled. The couch sits in a warehouse and you're back to renting. But hey, you saved $400, right? You saved $400 on the couch and lost a $300,000 house. That's what really happened. That's the most expensive discount in American history. Before I give you the 7, you need to understand why. It's called the danger zone. It's a pre-approval killer because most people think pre-approval is a guarantee. It is not. Pre-approval is a snapshot. It's a lender saying, based on what your financial profile looks like today, we believe we could qualify you for this loan. But between that day and the closing day, which can be 30 to 60 days, they verify everything again. Credit, income, employment, debt, assets. If anything changed, even something you think good, like a raise or a paid off card, they calculate it. And if the new numbers don't fit the formula, you get denied. So the 2-stage underwriting process goes like this. Stage 1, what happens? They pre-approve and they automatically screen your profile. They use self-reported income, a soft credit pull, estimated debts. And stage 2 is the final underwriting. It's manual verification, tax returns, pay stubs, bank statements, a hard credit pull, and employment verification. Remember, stage 1 is the easy part. Stage 2 is where loans die. And the 7 things I'm about to show you, they all show up in stage 2. Mistake number 1, you bought a car before closing. This one kills me every single time because you got pre-approved. You know you'll need a car for the new house because the commute is longer. So you go to the dealership, you finance a $30,000 car. A monthly payment is $450. You think, I can afford this? My income covers it. Here's what the lender sees. Your debt to income ratio just went up by $450 a month. If you were at 41% DTI, which is close to the 43% ceiling, you just hit 44%. That's above the automatic denial threshold for conventional loans. Your $450 car payment just pushed you from approved to denied. The lender doesn't care that you can afford it. They care that the math says you can't. So here's the rule. Do not buy, lease, or finance any vehicle between pre-approval and closing. Not a new car, not a used car, not a lease. If the payment shows up on your credit report, it shows up in your DTI. Wait until after closing. A $450 car payment is the difference between congratulations on your new home and we're sorry, but we can't move forward. That's it. Just $450. Here's mistake number 2. You opened up a new credit card or a store card. The couch story I just told you, that's not a hypothetical. Mortgage brokers on Instagram are literally posting about this right now during May of 2026. One wrote that 20% discount at the furniture store isn't worth losing your mortgage approval. No new credit cards. Another said, I've seen buyers get denied because they opened a store card the week before closing. This is happening to real people in real time this month, this year. Every new credit application triggers a hard inquiry. Hard inquiries drop your score by 5 to 10 points each. If you're at 625 and the FHA floor is 640 for some lenders, a single hard inquiry from a store card can push you below the minimum. One card, 5 points, and you're denied. So here's the rule. 0 new credit applications between pre-approval and closing. Not one. Not even a soft pull pre-qualification. Not even just to see. Nothing. Nada. If you need furniture, pay cash or use existing cards you already have. If you can't pay cash, you can't afford the furniture yet. The furniture will still be there after you close. The house might not be. Mistake number 3, you change jobs even for a raise. This one feels backwards, right? You got a new job that pays more money. How could that possibly hurt you? Here's how lenders want to see stable, predictable income. A new job. What the fuck? Here's how. Mistake number 3, you change jobs even for a raise. This one feels backwards, right? You just got a new job that pays more money. How could that possibly hurt you? Here's how. Lenders want stable, predictable income. A new job, even at a higher pay, resets the entire clock. They need to see pay stubs from the new employer. They need an offer letter. They need confirmation you pass any probationary period. If you move from W-2 to commission, from salary to bonus base, from employed to self-employed, the underwriter has to evaluate your entire income structure. And that takes time. And that takes documentation. And that takes your closing date and pushes it forward. I've seen people change jobs for a $15,000 a year raise and lose a $300,000 house because the new income structure couldn't be verified in time for closing. So here's the rule. Do not change jobs between pre-approval and closing. If a new opportunity is life-changing, tell your lender first. They'll tell you if it's safe or if you need to wait. But don't surprise them. Surprises kill loans. Mistake number 4, you made large undocumented bank deposits. Your parents want to help you with the down payment. Your friend owes you money and finally pays you back. You sold your car for cash and deposited it. All of these feel normal. All of these are normal. But to an underwriter, a large deposit that wasn't on your original bank statement is a red flag. They need to know where every dollar came from. If you can't document the source, they assume it's borrowed. And borrowed down payment money means more debt. More debt means higher DTI. Higher DTI means potential denial. So here's the rule. Any deposit over your normal pattern, usually anything over $500 to $1,000, depending on the lender, must be documented. If you're receiving a gift Get a gift letter signed before the deposit hits your account. If you're selling something, keep the paper trail. If it's cash, don't deposit it until you talk to your lender. So the lender doesn't care that your mom gave you $10,000 out of love. They care that the $10,000 isn't a secret loan from somewhere that adds to your monthly obligations. Document it or don't deposit it. Mistake number 5, you missed a payment, even one, during the mortgage process. This is the cruelest one. You've been paying everything on time for years. You're pre-approved, and then 1 month, you forget to pay a credit card or a utility bill or your auto loan. Just one missed payment, one 30-day late on your credit profile, and when the lender does their final credit pull, 42 to 72 hours before closing, it appears. A 30-day late payment can drop your score 60 to 110 points. No, that's not a typo. 60 to 110 points for one missed payment. If you're at 640, the FHA floor, many lenders, you drop to 560, your loan is dead. It's not delayed, it's absolutely dead. So here's the rule. Set auto pay for the minimum payment on every account. Credit cards, auto loans, student loans, utilities, phone bills. Don't delay. Set it today, not tomorrow, not next week, today. Then manually pay the full balance weekly. Auto pay is your safety net. Manual full payments are your strategy. One late payment between pre-approval and closing can kill the entire deal. This is the same rule from the 90-day video. If you watch that one, you already know auto pay is everything. No exceptions. The mortgage process is not the time to test your memory. Set things up on auto pay. Mistake number 6, you closed a credit card thinking it would help. This ties directly to my video about why your credit score didn't move after paying things off. You paid off a card, you feel good, you close it because you don't want the temptation. But your score drops because closing a card reduces your total available credit, which spikes your utilization ratio and reduces your average account age. You literally made your credit profile worse by doing what you felt was responsible. Now imagine you do this during the mortgage process. You close a paid off card to clean up your credit. The lender repulls your score. It dropped 30 points because your utilization spiked. You fell below the minimum. That means denied. So here's the rule. Do not close any credit cards between pre-approval and closing. Not one. Just put them in a drawer, set a $10 auto pay charge, and keep them going. Keep the available credit. Keep the account age. Keep your score. Close nothing until after you have the keys to your house. If you haven't watched my video on why closing a paid off card drops your score, go watch it after this. It's the exact reason I'm telling you not to do it now. Mistake number 7, you co-signed for someone else. Your kid needs a car, your sibling needs an apartment, your friends need a loan, and they ask you to co-sign and you signed. You're not the one making the payments and it's not your debt, right? Wrong. Co-signing makes you legally responsible for the full amount of the debt. The lender sees the entire co-signed loan as your obligation, even if the other person pays on month every time. The debt is on your credit report and it's counted in your DTI. That $300 a month car payment you co-signed for your daughter, it's now a $300 a month hit to your debt to income ratio. The same $300 that can push you from 41% to 44% and kill your mortgage. So here's the rule. Do not co-sign for anyone between pre-approval and closing. Not your child, not your parent, not your partner. If someone's application requires a co-signer, it's because the lender believes the risk is too high for one person to carry. Adding your name doesn't reduce the risk. It adds your mortgage to the risk list. So you helped your kid get a car, you lost your house. That's the trade. Most people don't know till it's too late. So here's the bigger picture. Let me zoom out. Mortgage rates just hit a 3-year low, 6.06%. on a 30-year fixed. The window is open. Freddie Mae and Freddie Mac are changing. So here's the bigger picture. Let me zoom out. Mortgage rates just hit a 3-year low, 6.06% on a 30-year fixed. The window is open. Fannie Mae and Freddie Mac are changing their credit score requirements. VantageScore 4.0 and FICO 10T are now approved for mortgage underwriting. Rent payments now count for the first time ever. The rules are shifting in your favor. But here's what the rules can't protect you from, and that's you. The system is giving you more access than it ever has. 7 out of 10 people who get denied after pre-approval, it wasn't a mistake, it was a mistake they didn't know they were making. The veteran in East Tennessee who was days from closing on a VA refinance and the lender called it off, the Reddit user who got denied because of a medical loan they took out 3 years ago for their mother, the first-time buyer who financed a couch, lost the house, and is still renting because nobody told them, don't open new credit during the mortgage process. These aren't bad people. These aren't irresponsible people. These are people who were one piece of information away from the biggest purchase of their life. And that information wasn't given to them until now. So now you know exactly what not to do in between pre-approval and closing on the loan. So if you've gotten any value from this video, drop a fire emoji in the chat, hit that like button, smash that subscribe button, leave a comment. It helps the algorithm get this video in front of more people. And to your mortgage